Lesson 14, Harmonic Vibrations and Beats. Before we get started, I'd like to point out there's a sign in the top left-hand corner of this slide. That is a sign that you will see throughout this lesson. Whenever you see that sign, there will be some important information on that page. You may want to memorize it, study it, understand it, and incorporate it into your trading methodology. You'll also see in the bottom center of this slide a number. That is the number of the slide that we are on. During this lesson, if you lose yourself, just match that number up with the number of the slide in your workbook, and you should be caught up with us. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis, but are very applicable anywhere you can pull up a financial chart. One of the most profound statements, as you've heard me say over and over again, I have ever heard is this one: successful traders will do what unsuccessful traders can't and won't do. There is a big difference between successful traders and unsuccessful traders. There's a big difference between successful people and unsuccessful people. Whenever it's time for you to make a decision in your life, you may want to incorporate this statement and ask yourself, what would a successful person do in this situation? When it's time to make a trade, don't focus in on the greed. Ask yourself, what would a consistent, successful trader do in this situation? This statement can really participate in helping you out in your trading career. There is a 21-day 3% rule which states the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. The focus of this lesson is to teach you about harmonic beats and to have you apply that knowledge into your trading methodology. You do not want to lose this information. I will tell you, this information has had an incredible impact on many people's ability to trade in the market. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You will learn how to read a trading chart and be introduced to the technical side of harmonic vibrations and beats. You will learn the natural laws of harmonic beats and see how they can help you improve your trading. You will learn that most financial markets move in a harmonic vibratory beat fashion and that you can figure it out for profit. You will learn to create a trading plan based on these laws and how to financially protect yourself at support and resistance on every trade. Now, before we get started, I would like to review reading a trading chart and placing orders. We are watching Japanese candlesticks which monitor the open, the high, low, and the close, and that there's bullish and bearish candles. Bullish candles represent white candles in this lesson, and bearish candles represent black candles. We are looking at a bid chart, and most traders look at a bid chart when it's time to trade. An ask chart looks identical to the bid chart, except that it is anywhere from 3 to 10 pips higher when it comes time to trading currencies. In all markets, traders buy on the ask and sell on the bid. That is very important information. Buyers buy from sellers. Sellers sell to buyers. So you buy on the ask and sell on the bid. When it comes time to entering the market and placing your orders, remember every buy needs 2 sells. When you buy and you place your protective stop loss order, remember that sell is on the bid, which means the candles will have to come up and go through it in order to stop you out. Now, your protective sell stop is on the bid, which means all this candle has to do is come down and hit that and you're stopped out. Conversely, when you sell on the bid, you enter. If there's a 3 to 10 pip spread, let's just say there's a 5 pip spread, if you enter the market and the current price is 107.30, you are filled at 107.35. Your protective stop loss order is on the ask, which means if this market rallies and the candle does not hit your ask price, you may be stopped out. Please understand this as to avoid frustration as you trade. Types of orders we'll be using are market orders. A market order is an order placed at the market on the bid or the ask. A limit order is an order placed to enter or exit the market at the exact placed price or better with no slippage. And a stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched. It may incur slippage. Now let's look at this chart. Any order placed above or below wherever the market is called an open, working, unfilled order. If that order is a buy order above the market, that is then a stop order. And if that order is a sell order anywhere up here above the market, that is then called a limit order. These are the rules of trading. Any order placed below the market that is a buy order is called a limit order. When you buy below the market, that's called a limit order. When you sell below the market, that's called a stop order. Ordering rules: every buy, if you're going to be a bull, you think the market's going to rally or go up, every buy should have two sells. One for potential loss. Quantify those losses before you trade. If you can't afford to trade, stay out. And a sell for profit. Now let's look at this chart. Lesson 6 teaches us that this market has entered into the buy zone. Market has entered into the buy zone. You enter on a buy, you're a bull. You need two sells, one for profit and one for potential loss. Ordering rules: when you're shorting the market, if you think the market's going to go down, and that's one of the great things about trading currencies, there's no special rules or regulations in shorting the market. All you need to do is, with the click of a mouse, short the market. You will then be a bear. Your position will be short. You want the market to go down. Every sell should have two buys. Let's look at this chart. You short the market, you need a buy stop for protective loss and a buy limit for profit. OCO means one cancels the other. Whether you're buying or selling, you need a limit order for profit and a stop order for loss. Whichever the market hits first, it will cancel the opposing order. That way you're not left out there with an open order that is unfilled. In canceling and replacing, please remember this. Only cancel and place to the new last low after the market has made a new high if you are chasing the market in an uptrend. If you're chasing it in a downtrend, only cancel or replace to the last high after the market has made a new low. Now, lesson 3 as well as lesson 16 focus in on how to properly cancel or replace. These lessons are about technical analysis. Technical traders learn to read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. Now, why do you think charts can become predictable? Well, let me ask this question. Who trades in the market? Does the bank trade? Does a financial institution trade? Does a machine trade? Who trades? People do. People that work for the bank trade. People that work for the financial institution trade. People are the ones that trade. And people are creatures of habit. Charts monitor the buying and selling habits of the trader. Therefore, these charts can become predictable because people are predictable. Now, a chart is a chart is a chart, which means technical analysis is applicable to all markets anywhere you can pull up a financial chart. And once you've been educated on how the markets work, as far as technical analysis, you can start to control your financial future. I'd like to do a quick review on lesson 2, support and resistance. Remember, a high, two candles to the left, two candles to the right that are higher than the center high, and not all highs are resistance. A low is two candles to the left and two candles to the right that are higher than the center wick low or the body of the candle low, and not all lows are support. Let's look at a current trading chart. Whenever you see a current trading chart, you want to Scan the chart with your eyes and be able to visually see all your levels of resistance as well as all your levels of support. Remember, as you track your levels of resistance, every level, when you go from level 1 to level 2 to level 3, every level needs to be higher than the previous level of resistance. Just as well, every level of support needs to be lower than the previous level. Finding resistance is like walking up a set of stairs. Finding support is like walking down a set of stairs. Bulls want to take control of the market and establish new highs and take out the old levels of resistance. Bears want to take control of the market, take it down to new lows, and take out the old levels of support. All protective stop loss orders must be at the last low if you're buying and the last high if you're selling. Let's look at this chart. For whatever reason, if you buy, your protective stop loss order needs to be at the last low. Focus in on those losses. Quantify those losses. If you quantify your potential losses, the profits will take care of themselves. Every sell needs to have a protective stop loss order which will be at the last high. If you are bearish, place your protective stop loss order at the last high or the latest level of resistance. If the stop order is too far away from your entry point where you want to get in the market and does not meet your equity management requirement, pass on the trade and go find another one. Let's review trends and trend lines. Lesson 5. This is very important. Whenever the market is making higher highs and higher lows, it's called an uptrend. We draw our trend lines across the lows of support. See how we draw our trend lines across the lows of support? Now, there are three primary upward trend lines forming at any given time. One is an inner, outer, and long term. Lesson 5 teaches you how to buy and sell trend lines. Please review it. When the market is creating a lower low and a lower high, that is called a downtrend, and we draw our trend lines across the highs of the highs of support, the highs of resistance. Draw your trend lines in a downtrend across the highs of resistance. Once again, there's three primary downward trend line, a long-term outer, an outer, and an inner. Lesson 5 focuses in on how to trade those trend lines. Now let's review Lesson 7, which is price swings, extensions, and Fibonacci numbers, because you need to understand that as we do this lesson. Leonardo Fibonacci discovered the universal numerical sequence, which means the sum of the previous two will equal the sum of the next. 2 plus 3 equal 5, 3 plus 5 equal 8, 5 plus 8 equal 13, all the way through infinity. 55 plus 89 equal 144. 89 plus 144 equal 233. Take 89, 144 equals 233, and now start to divide them. When you divide 89 by 144, you come up with 0.618, and when you divide 144 by 233, you come up with 618. Now if I start dividing 233 by 144 and 144 by 89 and 89 by 233 and 233 by 89, I come up with a whole series of numbers. They are a 382, 50, 618, 786, 1.27, and 1.618. We equate these to percentages. 382 equals 38%, 50, 50%, 618, 62%, 786, 79%, 1.27, 127%, and 1.618, 162%. You learn this in detail in Lesson 7. Now, Fibonacci ratios are hidden potential levels of support. In an uptrend, as the market waves, it'll bounce at one of these Fibonacci numbers. And we learned that if it bounces at a 382, 50, or 618, it is going to rally. If it takes out the previous high, it will then or should continue to go to the 1.618 extension, just as you see here in this chart. See how the market rallied, came down, bounced right at that 382, and went straight up to the 1.618 extension. If the market bounces at a 786, it will only go to a 1.27 extension if it takes out the previous high. Look at how it bounced here at the 786, When it does that, the market is slowing down. Look at how much time it took to get to the 1.27 extension. We learned that swings move at different speeds. A 382 bounce, which is a very tradable swing, moves very rapidly. It offers fast profit. It offers being able to get in and get out of the market in a short period of time. You can see as the markets bounce at a 50, 618, or 786, it is slowing down. Now, downswings work exactly the same way and in the same numerical sequence. In a downswing, as the market retraces, these 382s, 50s, 618s, and 786s become hidden levels of resistance. The market should bounce at one of these locations if the downtrend is going to stay consistent. Now, in a downtrend, if it bounces at a 382, 50, 618, U-turns and takes out the previous low, it should go to the 1.618 extension. Let's look at here. Bounces at a 382, goes straight to the 1.618 extension and bounces. Now, in a downtrend, if it bounces at a 786 retracement number, U-turns, takes out the previous low, it should go to a 1.27 extension. Look at how it came down. Here's the original swing, retraced to a 786, bounced, and went to a 1.27 extension. If your data provider does not have Fibonacci numbers, please contact us immediately and we will get you hooked up with a company that has the Fibonacci ratio numbers as a part of its software. Downswings move at different speeds as well. They go from fast and aggressive 382 bounces to 786 bounces. Now, the reason you want to trade a 618 or 786 bounce, here's that important information, is just in case the market decides to reverse, break a trend line, crown. These are lessons you learn. Your losses will be small. And remember, if you listen to the market with your eyes and look where it's been, it will tell you where it's going to go. Look at how the market rallied, came down here, bounced to the 618. If that was your entry, you were probably planning on getting out at a 1.618. But instead, it came back to a 786. Now that it came back to a 786, you will now need to adjust your limit, look where it's been, and it'll tell you where it's going to go. There's the 1.27 extension. Now, lesson 14, harmonic vibrations and beats. This is probably one of my favorite lessons to teach because I never cease to be amazed at how the market that handles a $1.5 trillion daily volume can work not only in a Fibonacci sequence, but in a harmonic vibratory sequence. The knowledge of this harmonic vibration can be very, very helpful to your financial success. Because believe it or not, the market is governed by natural laws. You'll learn a lot about that in lesson 7 on price swings of Fibonacci numbers. Because the world is governed by natural laws, and none of us are above these natural laws. Now let's look at a piano and how it vibrates as it's played. If you look at keys, all keys vibrate. But for example, key C vibrates at 264 vibrations per second. Key E vibrates at 330 vibrations per second. Those vibrations become the sounds we hear. Key A vibrates at 440 vibrations per second. Believe it or not, when you start to take like key A and divide it by key C, I believe those are the two numbers. There's several keys that the ear likes to hear, and the body can incur goosebumps when listening to those keys because the mind and the ear and the body likes to see and hear things that are made in a Fibonacci numerical sequence. But if you take 264 divided by 440, I believe you come up with 0.618. Key C vibrates at exactly 0.618 of key A. Go into lesson 7, and I think we discussed that a little more in that lesson. But what things vibrate in our lives? Sounds. Whenever we listen to any kind of music, we're listening to vibrations. Earthquakes, they vibrate. The ocean and the water, it vibrates. How about radio waves? They vibrate. Let's look at water. Water usually is calm if there's no wind pushing it or moving it. But then all of a sudden, if a boat goes through the water, the boat disrupts the calmness of the wave, and it now starts to vibrate. Look at how it vibrates until it dissipates. Now as the market moves, it vibrates. It vibrates up, vibrates down, and it vibrates sideways. Look at as the market, as it's rallying. Look at these waves. Don't these look like waves? Well, actually, they're vibrations. And in a Fibonacci sequence, they vibrate in a numerical Fibonacci fashion of 618, 1.618, 618, 1.618. Let's look at this chart. Vibrates up, retraces back to a 618, goes to a 1.618. New swing starts.